I've been trading the options wheel. You start the options wheel by selling cash secured puts against a security. If the stock rises, the put is not assigned and you keep the premium from the sale of the put. On the other hand, if the stock drops below the strike price of your put, then you must purchase the shares at the strike price. Here's the stock price of Occidental Petroleum, or OXY, OXY as I call it. It's up a whopping 28% this month, and the premiums from selling puts have been huge, as much as 3% per week for a 30 delta put. This means you could make like 15% a month if you keep selling these weekly puts without getting assigned. Today's March 5th, and I sold a 30/50 put expiring in 7 days on March 12th. That's about 3.5% below the current stock price, and that seems like a safe strike. But let me tell you, if the stock can go up 28% in a month, then it can definitely go down 28% in a month. The Saudis have been maintaining lower oil production, and this has driven the price of oil over $60 a barrel. If the Saudis suddenly decided to sell more production, then the price of oil would fall quickly, and the price of Oxy would also drop quickly. So what if Oxy closed at $26 on expiration day? You would then be forced to purchase 100 shares at the strike price of $30.50. The market value of those shares is now $2,600, so you're sitting on a paper loss of $450, or about 15%. People like to say that selling cash secured puts is low risk, easy money, but there's a definite downside risk to big drops, big sudden drops like this. So instead of selling the naked 30/50 put, what if you also purchased a long put at $28? This is simply a short vertical call spread. In this case, I got 75 cents in premium for selling the short put, and I paid 25 cents for the long put. So the net credit of the credit spread is 50 cents, which is still a fantastic 1.6% per week premium that I've collected. So you have two possible exits for the trade. If you think that the price drop reflects a sudden negative change in business conditions for Oxy and you no longer want to own those shares, you can simply buy back the credit spread on expiration day for $2.50 or less. You take a $250 loss, it's about 9%, and that's certainly better than a 15% loss with the naked put. Your other exit is to sell the long put for about $2, which is the strike price minus the share price, and then purchase the shares for $30.50. You still have a $250 paper loss. If you sold naked puts, on the other hand, then your only exit is to take possession of the shares at a 15% loss. So I don't typically use the strategy that I've outlined here unless I'm trading a very volatile underlying, and Oxy is a very volatile underlying. 28% in a month, it's a big move. I still want to simulate a long position in this underlying, but I want to smooth out the volatility, and that's what this strategy accomplishes.